Okay, welcome back for the next phase of the manufacturing account. Remember, we stopped at the point where we got net work in progress when we added to the opening, when we added to the factory overheads and prime cost, we get cost of production. That is where we stopped the first part. Now, the next part, the second part, is to continue from where I stopped, which is to generate factory profit. The factory department can charge a profit, a percentage as profit for the factory, which is called factory profit. So let's assume it is 10%. So if factory charges at 10% of cost of production, that means if cost of production, let's assume a value. If cost of production is $20,000, then 10% of $20,000. That means at this point, let me create. So this is continuation of this. So I got cost of production. I got 20,000. Remember, that's this plus this. What I got. Now, factory profit is 10% of cost of production, which is 2,000. This is an assumed value. So that means the amount that will be charged to sales department or the sales department is 22,000. So, and this is called transfer to sales department, which means the value of goods received by sales department is 22,000, though it cost the factory department 20,000, and they are sending it out to the sales department. Now, sales department will accept the goods as if they were buying it from an outside business. Because remember, I said earlier, manufacturing department is a cost center. So when they are charging profit, then it becomes a profit center on its own. But whether it's just a cost center or a profit center, it is an established center on its own. So when it sends goods to the sales department will accept it as if they bought the goods from somewhere. So that one becomes their own, technically, purchase cost. Purchase cost. Sales department will accept the goods as if that's the cost of purchase for them. But it is assumed that manufacturing department is a special or separate department on its own. So this is the end of the manufacturing section. So if a question asks you to prepare manufacturing account of a business, this is exactly the process you go through, except it is less than this. It is not more than this. Once you add your prime cost to your factory overheads, add it to your net work in progress, if you have, then you get factory cost of production. If there is charge by the factory, then add that factory profit to the cost of production to give you the transfer to sales department. Now the next thing is the income statement proper. Now, sales, of course, sales department takes over from income statement. Income statement shows us sales and cost of sales to get gross profit. Then profit and loss part shows us income, additional income plus gross profits if we have, less all expenses. All admin or office expenses, sales and distribution, administration expenses, they are done as expenses. A factory cost is done here. Remember the apportionment we did the other time. The other half that deals with the office is taken care of in the income statement. So sales, let's assume it can be any value. Let me assume just a big value, $50,000. This is assumed. Then if you have cost of sales returns, less sales returns to get net sales. Then we now go for cost of sales. How do we get cost of sales in this topic? the same thing as we have done already in normal sole traders income statement or for a retailer, which starts with opening inventory of finished goods. Remember, we already talked about opening inventory here. That's for raw materials. We talked about another opening inventory here. That's for work in progress. Now, in income statement, the opening inventory is for finished goods. This is the department that sells goods. They don't produce here. So it is only about finished goods that we look for in this part. Now, opening inventory of finished goods plus purchase of finished goods. Remember a few minutes earlier, I said technically the amount that is transferred from factory department is technically your purchase value. In normal instance, a manufacturing business does not buy finished goods. It buys raw materials and converts it to finished goods, and it is transferred to sales department to sell. So that means the purchase in normal case or most cases is the cost of production amount transferred. So in this case, how much was transferred? 22,000. Do you get it? Now, normally, and in a normal case, a manufacturing business, for emphasis, I'm repeating this, does not buy finished goods. It buys raw materials. It doesn't purchase finished goods. But in an instance that a business is about losing a customer, let's say a customer needs 50,000 units of your product. You have produced 49,000, and you are not able to produce the 1,000 remaining, and the customer needs it, let's say, today, and otherwise the customer won't buy anything from you. It is in that instance that you can now buy finished goods from a competitor. Do you get it? Just to make up. So it is not usual, it is not common practice that in manufacturing account you are still going to have purchase of finished goods. It can happen only in the case that you don't want to lose a customer and you are not able to produce just enough. Do you get that? So, but normally cost of production transferred replaces your purchases. But in case the examiner tries to tweak the information and still put purchase of finished goods, remember it will be a small amount still added to the cost of production transferred. Please take note of that. So purchase of finished goods, let's say this is just 200. Now, if you have returns outward of finished goods, it's not common, deduct. Then we have, are you going to have carriage inward of finished goods? No, if you don't have purchase of finished goods, because if you are going to have carriage inward, it's on raw materials that you purchased. Yes. But you can have carriage outward. Later we are going to talk about that. Thank you for that question. We're not yet using carriage outward. But in case you bought this 200 and you paid to transport it inside, that's carriage inward of finished goods. It's not common, but if the examiner gives it to you, add carriage inward of finished goods. Let's say this 10, it's not usually so much. Then deduct closing inventory of finished goods. That can be 1,000, it can be anything, we are just assuming. That means 22,000 plus 210 minus 1,000. These are assumed values, please take note. So that gives us 21,210. Please let me calculate it and confirm the answer. Also take note, when you are deducting a value, try to put it in a bracket, enclose it in a bracket. For accounting, it's expected that you put your amount to be deducted in a bracket.
Yeah, you're correct.
Thank you very much. Now, if this answer is our cost of production, then Sales, I'm sorry, slip of tongue. This is cost of sales, not cost of production. We already got cost of production here. This is cost of sales, cost of sales. Now, sales minus cost of sales will give us gross profit. Please let me check the value. Okay, 28,790. That's our gross profit. Now, factory profit here is part of the business profit because factory department is part of the department of the business. So we bring it here. Factory profit. Now, someone may wonder, why do we still have to bring factory profit? Is that not time wasting or repetition that is not necessary? It is not unnecessary to put it here. It's actually required. But the profit made there is for a section of the business. And this is whole income statement of the business. So factory profit is part to be put here. And other additional income you have, like you have discount received, rent received, commission receivable, reduction in provision for doubtful debt, or profit on disposal of assets. If you have this, you add it to the gross profit. But for now, this at least must appear since you already generated it here. Then there is now a part that is important. If you had done O-level IGCSE or any ordinary level accounting, you would have just gone ahead at this point. But now I need you to take note of unrealized profit. Now, because the factory department at O-level IGCSE, this was not treated, so please take note. So if you are preparing for IGCSE, unrealized profit is not covered in your curriculum. If you are preparing for exam above IGCSE, you must take note of this. Unrealized profit is already going to be in closing finished goods. Why is that so? Factory department transferred something of 20,000 as 22,000 to the sales department, and sales department accepted this, you remember. Now, part of this was not sold. So does that mean that this 2,000 has been fully earned? No, it has not been fully earned if you have closing inventory, because they sent all these goods at 2,000 profit. That means if there is part of it that has not been sold, that means that part of profit for the factory has also not been realized. Hence, you must prepare what we call unrealized profit. Provision for unrealized profit. Provision for unrealized profit. Provision for realized profit account. Remember in the debt clip acronym or trial balance or accounting 101, these are videos that were already released in this channel. You can make reference to them to catch up. Debt clip is an acronym. Debt, DEAD, are those items in the debit side, CLIC, and P, those items will be in the credit side. P in clip is provision. Opening provisions will be in credit side. What I just said as acronym now is already in this channel as a accounting 101 or double entry system. You can relate to it. Now, provision opening will be in the credit side. At the beginning of this period, there was no opening inventories. That means there was zero unrealized profit. At the end of the period, there was closing inventories. That means on this, there was unrealized profit. This was not the unrealized profit. This was value of goods sent by production departments to them that was remaining. but it was cost plus profit. Cost plus profit of what percentage? What percentage was charged? 10%, thank you. So that means this 1,000 has cost and 10% unrealized profit. That has not been realized. This closing inventory as part of profit that was generated here that has not been realized, and this closing. Opening, there was nothing. Should there be something, we will look at it as well. But in this case, there was, let me just assume a value so that we can cover it once and for all. Let me assume this was 500. So let me adjust this answer back. Assuming this, there was opening inventory of 500 and closing inventory of 1,000. So what would this answer have been? And this.
Sorry.
21,710. So 50,000 minus 21,710. That's 28,290. Now this is good. Gross profit is 28,290. We're adding unrealized factory profit. Now this amount, assuming the factory has been charging at 10% to the sales department, which means this 500 has cost and 10% profit that was not realized from last year, but of course it has been sold this year. At the end, this 1,000 has cost and part of factory profit that has not been earned this year. So opening one comes here, closing comes here. Difference goes to income statement. So now, if 500 has 100% cost and 10% profit, what is the 10% profit? I will use math knowledge in this case. So math experts, you get this one quickly. $500 is 110%. Because 10% plus the 100% of profit is 500. So what is the 10%? We just cross multiply. 500 times 10 divided by 110 will give us the answer.
I already have it.
Oh, please let me show it to me. Let me see. 500 times 10 divided by 110. $45.45. $45. That means opening, or that means out of this, this was unrealized profit, this amount. What he helped me to do is 500 multiplied by 10 divided by 110. We cross multiply. That's mathematics knowledge. This times this divided by this. Now for closing, this is opening. For closing, this 1,000 has element of profit in it that was not realized. Until you sell it, you have not realized it. So that means 1,000 has 10% of profit in it. So what is that 10%? You just do as we did up, 1,000 multiplied by 10 divided by 110. So what did you get? 90.9. $90.9. So that means it's very, we already have the answer now to prepare unrealized profit. So, which is balance brought forward, this amount, 45.45. Then balance carried forward, 90.9. The difference between these two goes to income statement. There is an increase in unrealized profit, 45.45. 45.45. It goes to income statement. 45.45, since it's in the credit side here, it goes to be debited as expense in income statement. So expenses now. You can say increase in unrealized profit. You are unrealized profit. That is 45.45. Now, write this as working whatever, working 2, working 3. Because examiner, as you got this right, examiner is going to look at where you got the answer. Just write, you can put this as working 2, W2 in a bracket. Now, so that means we are done with the unrealized profit. At this point, I would like to take a break for you to go over what we did in step 2, second phase. The third phase, we'll be looking at the balance sheet. But before we go to the balance sheet, other expenses like office rent. Office, remember how we apportioned the other time? 4/7 was for rent, 3/7 was for factory rather. 3/7 of this goes for office. Just calculate it. Then distribution expenses, administrative expenses, all the expenses, all the office and selling of administrative, selling and distribution expenses, they come here. Discount allowed, sales commission, taking note of the adjustments, prepayments and accruals. You must take note of it. Depreciation of office equipment. Here we talked about depreciation of factory equipment. Here we talk about depreciation of office equipment. All that, add it and bring it here. So total of this income minus total of expenses gives us the net profit. So as I said earlier, I'll take a pause here, and in next phase, which I expect you to watch, I'll talk about the balance sheet and how we treat the inventories therein. Thank you.